guys. So the last thing that we studied on our previous video, that is part 2, was return on equity, right? We were studying chapter 1 of How Finance Works by Mihir A Desai, in which we were studying financial ratios, where the last ratio that we studied is return on equity. So let's continue from the next ratio, that is return on assets, right? No, now, return on assets is given by net profit by total assets, right? Now, what does this mean? Let's see. Often called return on assets, this ratio asks how much profit does a company generate for every dollar of assets. This corresponds to asking how effectively a company's assets are generating profit, right? So I hope you understood. This ratio tells us for every unit of asset owned. For example, if return on asset ratio is 1 by 2 or 1 is to 2, it indicates that for every 2 units of assets, 1 unit of net profit is generated. Now, please note here that net profit is the final profit in hand, that is which is generated by the company after deducting all the expenses including taxes and interests, right? So let's continue with the next ratio, EBITDA margin. Now this is an important ratio, EBITDA margin. Now what does EBITDA means? Full form of EBITDA is earning before interest and taxes, right? And what does DA means? This is the full form of EBIT. Now DA means depreciation and amortization, right? Then what is depreciation? Let me give a brief definition of depreciation. So depreciation is the charge over asset, right? The after year and tear of an asset over a period of 1 year, a certain amount is, it loses certain value, right? For example, if I use asset worth 10,000 rupees over a period of 1 year, then depreciation for suppose 10% depreciation rate we are given, then After 1 year, the value will be reduced to 9,000 rupees, right? So this is depreciation. Amortization is the same as depreciation. Uh, Rather, the concept of amortization is broader than depreciation. We will read in the further notes, right? So let's read. EBITDA is one of the all-time great finance acronyms and is best said quickly EBITDA. It's also an indication that we are moving away from the accounting idea of profits and towards emphasis on cash in finance. What is EBITDA? Let's begin by breaking it into two parts, EBIT and DA. EBIT is just a fancy finance term for something you already know as operating profit. If you work up from the bottom of profit statement, you can recharacterize operating profit as earning before interest and taxes, right? Since some companies have different tax burdens and capital structures, EBIT provides a way to compare their performances more directly. For example, an American publisher and a German publisher might face different tax rates. Net profit, which factors in taxes, would provide a distorted view of EBIT, which excludes tax charges, would not. What about DA? DA stands for depreciation and amortization. Depreciation refers to how physical assets such as vehicles and equipment lose value over time, and amortization refers to that phenomena but for intangible assets. The reason emphasis DA is because they are expenses that are not associated with outlay of cash. It is just an approximation of the loss of value of asset. Suppose you build a factory. In accounting, you have to depreciate it and charge yourself an expense for that depreciation. But in finance, we emphasize cash and there was no cash outlay. So EBITDA or earning before interest, taxes, depreciation and amortization is a measure of the cash generated by operations. Because DA was subtracted to arrive at EBIT, DA needs to be added back to get EBITDA. As we will see in chapter 2, the emphasis of on cash is a linchpin of the finance perspective. One example I will develop more fully later. Amazon has little profitability but significant EBITDA. Among the companies in table 17, it's notable that company D generates a remarkable amount of cash, 45%, or 45% for every dollar of revenue. Similarly, company L has a reasonable profit margin of 9%, but a whopping EBITDA margin of 28%. Why would that be? Let's see. From here, the financing and leverage concept comes, right? I will explain these terms, but first let's read it out. Leverage is one of the most powerful concepts in finance, and it corresponds roughly to our previous discussions of financing choices and capital structure. You may have friends in finance who get VP-eyed when they talk about leverage. Empires have been built and destroyed because of leverage, and you will see why. Why is it called leverage? The easiest way to understand the power of leverage is to recall the power of a lever in an engineering context. Imagine a big rock that you can't move by yourself. A lever will allow you to move that rock seemingly magically by multiplying the force you apply to the task, and that's a precise analog for what happens with leverage in finance. Just as a lever lets you move a rock you couldn't otherwise move, leverage in finance allows owners to control assets that couldn't be controlled otherwise. Let's consider your own personal balance sheet after you buy a home. What if no mortgages were available for you to buy a home? If you had $100, you could only buy a home that was worth $100. With a mortgage market, you can borrow money to buy a home that is worth, say, $500. Let's see what your balance sheet looks like in under both these circumstances. Now see, this is a balance sheet given, but there are two cases. Case A for when you have $100 in your pocket and you buy a house worth $100 only. And the second case is you have $100 in your pocket, but you want to purchase a $500 home, so you borrowed rest 400 dollars, right? So in both the cases, let's see what is in case 1. In case 1, In asset side, it will appear $100 home, and in liabilities, it will appear $100 net worth, right? But in case B, assets $500 home, and liability 400 mortgage and 100 equity, right? So this is how it will appear in the balance sheet. In effect, leverage allow you to live in a house you have no right to live in. It almost as magical as the lever helping you move a rock. Here is the big question. Are you richer in case A or case B? Some think you are richer in case A because you don't own anything to anyone. Some think you are richer in case B because you live in a larger home. In fact, your wealth is no different. In both cases, you have hundred of shareholders' equity. Leverage not only allows you to control assets you have no right to control, but it also increases your returns. Imagine that the house increases in value by 10% in the two cases. In case 1, the return to your shareholders' equity is 10%, but in case B, your return is 50% if the house value increases to $550, but the mortgage remains at $400, right? Let me explain this example. It's a beautiful example for explaining leverage. Now, first of all, leverage. What is this term leverage? What is the meaning of this term? Right? Leverage means, right, in financial terms, right? It is defined as anything which multiplies your capacity. And in financial terms, leverage is something which multiplies your purchasing capacity. Right. For example, a beautiful example is given in by the author. Let me give you the same example. Right. For example, suppose I have $100 in my pocket. I have not $100. Let me write 100 rupees. Then it won't be confusing. Option A is okay. I have 100 rupees in my pocket and I want to buy a home. Now I have two options. First option is I buy a home that is worth 100 rupees only. That is no debt or borrowing. In the second case, I have this option where people will give me additional $400. Sorry, additional 400 rupees so I can purchase a 500 rupees house. Now, see what is the difference. In this second case, I have a loan of $400, sorry, 400 rupees, right? This loan is my liability. But what is the magic of leverage? Let me explain. Suppose the value of the house increases 10% over a span of 1 year, right? So I have house A, I have house B. If I purchase house A, then its value will 10%, it will increase by 10%, right? After 1 year, so its value will be 110. So 10% goes into entirely into my pocket. But in this case, right, see, uh, in first case I have 10%, I invested 100 rupees, I got 10 rupees as return, so return on equity is, sorry, 1 by 10, right? But in case of B, it the next year it will become 550 in value, right? So 50 rupees I have earned, and so if this entire 50 is added to my profit, then return on equity will be 50 by 100, right? 50 by 100, because this 400 part people have loaned me, right? This 400 part people have lent me, so that I can borrow the house. Of course, they will be paid after a certain time, but by that time comes, I will be using this 50 rupees again for buying some other house and engage in the same business for some time, and it might be observed that I have already earned around 500 profit, that is 100%, sorry, 500% of my equity, 500% of my equity, from which I can easily pay back the loan, right? So this is the concept of leverage. This 400 is my leverage and this 100 is my equity, right? So I hope I am able to explain. Let's continue reading. Unfortunately, it's not all milk and honey, because if house declines in value by 20%, the return to your shareholders' equity is 20% in case A, but in case B, your return is minus 100%. So managing leverage is critical because it enables you to do things you couldn't do otherwise, and because it magnifies your returns in both cases, right? So what is told is that if I talked about profit, right? I talked about when value of the house upgrades, goes up. But what if it goes down? Suppose it goes down by 20%. So I am left with 80 rupees as worth asset, right? I am left with 80 rupees worth asset. But what if in this case value goes down by 20%? In this case, I will suffer huge losses, because it then in that case it will be 20% of 500, right? It will be 20% of 500 or 100 rupees. So 100 rupees is my loss. So 100 rupees is my loss, and hence the overall loss is 100%. In this case our loss is 20%, but in this case our loss is 100%, because this 400 will be repaid no matter what. This 400 has to be repaid no matter what, and if it carries certain interests, then that interest has to be paid as well. But in this case, since we have no debt, so the entire loss goes from our pocket. But in this case, my own losses, my own loss goes from my pocket, as well as loss arising out of this amount 400 also goes from my pocket only, right? That is why managing leverage is a difficult task. So let's go to the next ratio, that is debt to assets. Right, total debt by total asset. Debt to asset ratio is given by total debt by total assets. Now, as we can see, this ratio indicates how much debt we have for every unit of asset. For example, if our debt to asset ratio is 1 is to 2, right, or 1 by 2, that means for every 2 units of asset I have accumulated 1 unit of debt. That means 1 unit of asset is, the remaining 1 unit of asset is self financed or equity. Now see, earlier I referred equity share as, what is equity, tell me. Equity is something which is owned by me. Now, why the shares which the shareholders buy from my company, right? Those some shareholders are called equity shareholders, and the money they spend on my company is also, I will treat them as equity. Now, do you have any idea why is it so? That's because there are certain properties of equity shares, right? First and very important property is equity is owner's capital. Equity is owner's capital, right? That is why all the funds generated from equity is termed as the own fund of the company, right? And that is why the equity shareholders are also called owners of the company, right? I hope I am able to explain. So let's see the next ratio, debt to capitalization. Ratio number 8, debt to capitalization, right? Now the ratio is given by debt plus shareholders equity. So let's read. The ratio of long-term debt to capitalization provides a somewhat more subtle measure of leverage by emphasizing the mix of debt and equity. The denominator in this ratio is capitalization, and the combination of a total debt and equity. As we saw, there are two primary types of financing for a company, and we think about them differently. Debt has a fixed interest cost associated with it, while equity holds a variable rate of return. which means it fluctuates along with ownership rights. This ratio tracks what proportion a company's financing comes from debt and therefore diverts attention from liabilities that are part of operations. Right? So basically, this ratio tells us what percentage, what percent of total leverage is debt, right? What percent of total leverage is debt? Now this is our total leverage and this is debt. Why do we need this ratio, or what is the importance? What is so much important about this ratio? The importance of this ratio is uh, the difference between debt and equity. Usually, when in the, before investors invest into a particular company, it prefers that the debt of the company should be minimum, right? Debt of the company should be minimum because in cases of debt, what happens is it carries certain interest. It carries certain interest. But in case of equity, it is not the case because equity shareholders returns can fluctuate from time to time. So that is why investors always prefer that the company in which they will be investing will have minimum debt to leverage ratio, right? Assets to shareholders equity. Now this is our ninth ratio. Now it is given by assets by shareholders equity. Right? It is given by assets by shareholders equity. Now let's read. Leverage provides the ability to control more assets than an owner would otherwise have the right to control. This ratio tells us precisely how many more assets an owner can control relative to their own equity capital. As a consequence, it also measures how returns are magnified through the use of leverage. Right? As I discussed earlier, how leverage can multiply your returns, or even in that case, diminish your returns, right? So what does this asset to shareholders equity means? It means how much asset a company hold in comparison to its leverage, right? So in that so that uh, in they can but they can invest more in the leverage, right? Uh, the company can borrow more funds. In simple terms, the company can borrow more funds if it has an adequate asset to shareholders equity ratio, right? For example, if assets to shareholders equity ratio is 1 is to 2 is to 1, right? 2 is to 1. That means the company has 2 units of assets for every 1 unit of leverage, right? So the company can risk to gain or rise more leverage, right? Let's look at the next ratio, that is interest coverage ratio, which is given by EBIT by interest expense. It indicates what fraction of the earning before interest and taxes is spent on interest expenses, right? The three previous measures were constructed from balance sheet, but the critical question is often the degree to which a company can make its interest payments. The ratio of EBIT to interest expense measures a company's ability to fund interest payments from its operations and uses only the data from income statements. Right. So hope you understood. Uh, it indicates. Now that we know EBIT is also called operating cost, so I can write it as it indicates what fraction of interest expense is amount earned as operating cost, right? Now let's look further. As one example, a ratio of 1 indicates that the company is just able to make its interest payments with its current operations. In your own life, consider the comparison between your monthly income and any mortgage payment as an analogous measure. A hybrid measure using elements from both the income statement and the balance sheet, that is debt by EBITDA, is a way to combine information from the balance sheet and the income statement. Productivity or efficiency. Productivity is a popular buzzword, but what does it mean from a finance perspective? In short, increase in productivity means you can squeeze more from less. More narrowly, productivity ratios measure how well a company utilizes its assets to produce output. Over the long run, increases in productivity are the most important contributor to economic growth. Now, these are effective or efficiency ratios that we are going to study. First is asset turnover. Let me put the heading as efficiency ratios. Right? Efficiency ratios. So the first efficiency ratio or the 11th ratio is asset turnover ratio. First, let me explain what are efficiency ratios. Efficiency ratios will primarily indicate how efficiently a company is able to use its assets to generate revenues, right? So, this is a direct efficiency ratio where it indicates every unit of revenue generated. Right, revenues by total assets is the asset turnover ratio, which indicates every unit of revenue generated from every unit of asset owned by the company. Right. Next ratio that we have is inventory turnover ratio, which is cost of goods sold by inventory. Right, cost of goods sold by inventory. Now let's see. Inventory turnover measures how many times a company turns over or sells all its inventory in a given year. Right. The higher the number, the more effectively a company is managing its inventory as it sells products. Because inventory is essentially a risky asset that needs to be financed. A higher inventory turnover is financially valuable. We can use this turnover number to get another measure of inventory management, days of inventory. Right. So inventory turnover ratio basically tells us how many times in a year the stock is emptied, right? It tells us how many times in a given year the company is able to sell its entire inventory, right? It carries a great value. This ratio, inventory turnover ratio, carries a great value because investors generally look at this type of ratios because this inventory thing is very risky asset, right? Uh, it can easily get converted into a what is called non-performing asset over a period of time, right? Just like I gave the example of BlackBerry, where $100 worth inventories were worth zero by no time. So type of this type of things keep happening in finance. That is why this ratio is important, right? So next ratio is days inventory ratio, 365 by inventory turnover. Now this is inventory turnover. Suppose the ratio is 2 is to 1, right? 2 is to 1. That means it will be given by 365 by 2 by 1, right? Let me write it down, which is given by 365 by inventory turnover, right? Dividing the number of days in a year by the inventory turnover provides the average number of days a piece of inventory is kept inside a company before it is sold. Right. Take a look at company C in table 1.1. It turns over its inventory more than 30 times a year, which corresponds to keeping inventory around for slightly more than 10 days. In contrast, company B has an inventory turnover of only 4 times a year, which means that inventory is sticking around for almost 100 days. Right? Suppose our total inventory turnover is 10,000, right? So 365 by 10,000 will give us 0.365, right? Now what does this indicate? Actually it is 0.0365, right? Now what does this indicate? It indicates that how on an average how much inventory is uh, carried out on a daily basis, right? Or and the average number of days a piece of inventory is kept inside a company before it is sold. Okay, here I conducted a mistake slightly because inventory turnover in this case it will be the ratio, right? It will be the ratio. Suppose inventory turnover ratio was 2 is to 1. Inventory turnover ratio was 2 is to 1, right? In the earlier case, as we can see, inventory turnover ratio tells us how many times in a given year the company is able to sell its entire inventory. Now, if we want to know how many times in a day the companies or the same thing we want to devise day wise, in that case this ratio is used. It will be given by 365 by 2 by 1, that is 365, sorry, 3 365 by 1 into 1 by 2, that is 365 by 2, that is on an average 182.5. Now this indicates that the average stock is held into inventory for around 182.5 days, right? So this is what this ratio indicates.